there, I'm Scot King, mortgage broker for Pacific West Capital, located in Orange County, California. And we are a brokerage, and we are approved with lots and lots of lenders. And I wanted to make this quick introductory video to show you the basics of mortgages for agency types of loans. And so I've created a spreadsheet, which I will show you in just a moment. I just want to say that, I've been in business since 2002. And I've been in the industry since 1998 when I got my feet wet working at a couple local brokerages. So there are two types of licenses in California. There's the broker license, there's the salesperson's license, and if you are a salesperson, you have to hang your license under the broker's license. That's the way it is. It's always been, it's the law, it's the way it's always been. And unless you're working for a bank, you are restricted to working in your geographical territory, which in my case is California. If you're looking for a loan in a state besides California, I can only help you if it's an alternative lending product, which I will discuss in other videos. But for now, I want to get into agency loans, and we'll go over that in just a second. So stay tuned. Oh, and if you like this type of content, I really appreciate it if you will click the subscribe button and hit the little bell, and you will be notified each time I release a new video. Thanks, and then without further ado, let's go ahead and get into the spreadsheet here.
Right, so here is a spreadsheet, and as you can see, there are actually two loans on it, one here for $300,000 and one over here. And so both are at the 6% interest rate. This one is a fully amortized loan, and this is an interest-only loan. So, and then what does this mean, fully amortized? This payment you see here will reduce this $300,000 balance to zero in 365 payments. So, actually 360 payments. And how do we get this number? Well, there's a formula for it, and it has to do with discounting cash flows. And actually, I use a calculator. It's called an HP 12C, and which I've been since the 1980s. It's a very good calculator, and everybody uses them in the mortgage industry. And so, this is the interest here. 6% of 300,000 is this number, and you subtract this from the 1798. And so this is the amount of principal reduction we have. So this balance is this 300,000 minus the 298 and 65 cents. And so you'll do that each time. You'll take this balance now, this 299, and multiply that by 6%, and then this will be the interest over here, and then you will again subtract the interest from this number to arrive at this amount of principal reduction, which you will subtract from the 299 to get this number here. So, and we'll show you that that does in fact reduce to our zero. What's going on here? So we have, 365 days in a year. So it's about right. It's rounding is the reason why it's not exact. So now this over here is an interest only, right? So all you're going to pay is interest only, which is saving you, this about $300 a month over the fully amortized payment. So why would you do that? Well, because rather than force the issue, in paying $300 more a month up here and having this principal reduction, you can have some flexibility and pay additional towards your principal when you want to. So for example, if you want to see how much total principal you paid in the first year, you would come like this, you would go like this, and you have $3,684, right? So rather than pay that, you could say pay $1,500 in principal, or you could pay $1,200 in principal by paying $100 a month, in addition to the $1,500. So if you paid $1,600 a month, you would have covered your interest, but then you would have had an additional $100 going towards the balance. So this would be $299.9 instead of $300,000, if that makes sense. Now lenders um, charge more for this type of a loan because it's a special feature which is available, but it's also a little more risk. So after 10 years, okay, after 120 payments, they're going to give you a fully amortized loan. And what that means is you've got now 20 years to pay off the balance, this $300,000. Well, that's going to cause it's going to require a higher payment. It's going to require, this is the fully amortized payment, this 2149. And as you can see, yeah, that's paying more money. But here's the thing, right? So most people don't keep their loans that long anyways. 10 years, most people are getting out or doing something else, consolidating their, refinancing their credit card debt, auto loans, or whatever into a new loan. And so this loan has gone bye-bye, usually before the 10 years are up. So here's your 120, right? And then, as you can see, the principal goes up. This goes up and this goes down. The interest gets less and less each time. Um, that's just the nature of how the calculation works. So, and when you get here, you have only $10, and this is almost 100% principal, reducing it to zero. So those are the two types of loans for most people. I will say, there are different types of loans for different types of borrowers. If you're talking about the best interest rates available, we're talking about agency loans. And what that means is wholesale lenders are going to sell their loans to Fannie Mae or Freddie Mac, which are the two government-sponsored entities, or GSEs, after they will fund your loan. And then Fannie Mae, Freddie Mac only buy certain types of loans. The lender has to abide by all of the underwriting criteria in order to sell their loan to them. So what happens is then when a borrower doesn't qualify for a traditional Fannie Mae, Freddie Mac type of loan due to whatever factor, the credit score could be too low, which is normally below a 620. That's an issue right there. They will not, Fannie Freddie will not buy that loan. That is a requirement. However, government loans are a little different. FHA loans, they go down to a 580. It's not just credit score. There are lots of reasons why the entity will not purchase a loan. So when we're talking about different variety or flavor of loan, we're talking about non-qualified mortgage, alt QM, alternative lending. And I will get into that in other videos. So this is just a quick, video on some of the basics. And I will wrap this up in just a second.
So that's an introduction to mortgages, and I hope you learned something. And if you did, if you still have more questions, please drop a comment in the comment section, and I will respond. And I will look forward to seeing you in the next video. Thanks a lot.